Hello, everyone. This is Greg. I just wanted to show you guys a tool that might interest you that I thought you'd want to see. And I just call it the NDC spreadsheet. I know this is something I got back in 2003 when I got my NDC certification. And I think, we have a lot of NDC certified people across the state. And that's the Economic Development Finance Professional certification. But this little spreadsheet is something that I've used to help do an initial assessment of businesses. And I've found it to be very helpful, especially as what I'll call a non-financial type. But here's what it is, and what you need for this particular analysis is 3 years of financial statements and 3 years of balance sheets. Or I'm sorry, 3 years of profit and loss statements or income statements, and then 3 years of balance sheets. And you can change the dates. All of the formulas are built in. I have them locked and protected on this particular one. You can change the dates, and you can change the percentages up here in case you want to do any annualizing. So, you basically enter your balance sheet information, enter your profit loss information, and then it gives you some good, easy to understand financial analysis. And here you see reconciliation of net worth, capital expenditures, ratio analysis, and operating cycle. And these are numbers that I've come to understand over the years. And then out here, it gives you a cash flow analysis from the terms of gross funds flow and permanent working capital. So let me give you an example of how I use this spreadsheet with a client, and this was sometime years ago. And here you see I entered the information, and this isn't a complicated. This was a little Main Street restaurant in Festus, Missouri. The business had burned, and they were doing some financial analysis on the business itself. So I use this sort of just to kind of give me a feel of where the business was headed, what kind of cash it was generating. So let's start with the balance sheet. And I'm sure everyone knows what a balance sheet is. It lists our assets and our liabilities. And it does give us, a valuation, a net worth. But the balance sheet does tell us some things we can look at, too, for those of you who aren't, the financial wizards like Aldous and Ken and Lisa and Crystal. And I'm going to leave someone out, so I'm going to stop now. But we look at our cash this is a 3-year period. You see our cash, all of a sudden our cash is rising. So typically we'll see that's a good thing, but it could be that we're not paying bills. It could be a lot of things. You'll see inventory is pretty steady. Now this is a restaurant, so it's important to understand. So this is a restaurant. So I know there are some ratios and some things that we watch for restaurants. They're not built into this spreadsheet, but again, this is just a good starting point for a spreadsheet. We have some net fixed assets, and when I look at this, I see the assets declining, which tells me that they're not buying new equipment. So they're depreciating their assets. So in the 3 years here, at least, we know that they're not spending money on equipment. When I think about a business, and this is something I learned years ago, when you think about a business, there are 3 places cash can go. There are only 3 places it can go if we're reporting it. Now, obviously, if we're not reporting it, it can go a lot of places. But if we're reporting cash, we can buy assets, we can pay down liabilities, or the owner can take it. Okay. So again, some of you financial people may not agree with that, but I just wanted to go through that. So if we look here, our assets are declining. Which is fine. We're depreciating assets, so we're not building any value to the business. If we go down here, it's understand, and most of you know, everything on a balance sheet is listed in order of liquidity or distance from cash, as I like to say. As we look on here, notes payable or any notes, letters of credit, anything that's due within 12 months, and then accounts payable, we'll see here. These are monies that are owed to vendors, for our inventory, I guess, for lack of a better term. And that's relatively consistent, little drop here. So we have more inventory, but lower accounts payable. And then our current liabilities are those liabilities that are due within 12 months. Now let's look at our long-term debt, 141, 131. So we're paying off our debt. So our total liabilities are decreasing as well. So our assets are decreasing, but our liabilities are also decreasing, which means we're paying off our debt. And I'm just going to go on a couple of items that, again, I personally look at on a balance sheet. I understand them. I know all of these have a value. Retained earnings. Retained earnings, I was always taught. I know it's a pretty complicated formula, but it's the historic profits that have been invested back into the business. And retained earnings over time should be positive and they should be increasing. Okay, that shows a good history of profitability and cash going back into the business. If we see here, we had negative retained earnings here, but they are positive and increasing, at least relatively, they're increasing dramatically on this spreadsheet. So just a quick look at the balance sheet that tells us a few things. One, our assets are depreciating. We're not investing a lot of cash into the assets. Our liabilities are decreasing. Now, I didn't look at this, but I would guess that we're meeting the terms of the loans here. I don't see a lot of cash activity, so we're probably not paying off debt faster than we have to. And so just some things to look at, okay? Now we'll go over, and this income statement is a little different from some of the income statements you might see. And again, it's why I like this tool, is because it lets us bring out some discretionary expenses. You know, in some valuations, you'll see a multiplier times SDE, and SDE is seller discretionary earnings, and this is income or cash that the owner pays that he or she may, you know, doesn't necessarily have to pay or collect, or that a new owner may not necessarily pay or collect. So, but if we begin, we look at our sales for the past 3 years, and this is 2005, 2006, 2007. We'll see our sales have gone from 251 to 521 to 641. So here I would have a little bit of concern because this is relatively rapid growing sales. We've increased it about 2.5 times over 3 years, which for a restaurant is pretty fast. And as I look back, if you'll recall, I don't have any short-term lines of credit here. Okay, so I don't have a line of credit or something to cover. So this is something that you know might concern me. It did with this client. As we look down, then we'll see cost of goods sold. Now for a restaurant, in my experience, typical cost of goods sold for a restaurant is around 30-35%, depending on the alcohol. Ron Miller taught me that. And if we look here on this cost of goods sold, it was 30% in 2005, 53% in 2006. And then back down to 39% in 2007. So this might be something to look into, or we could better compare it to industry standards. Now remember too, these are just numbers off of financial statements or off of tax returns, so they've not been audited. They're probably just compiled numbers or numbers that the business person has put together. Selling general administrative, again, we're 58%. 35% and 45%. So there's some pretty big differences here. So it might be something to look at in our SG&A and then our operating profit, 12%, 13%, and 15%. And I know for a restaurant, that's about standard, at least in my experience. As I look at these, there's nothing, again, that really jumps out at me, but I might have some concerns given the growth rate. All right. So now some of these in our expenses, that if we didn't count them in cost of goods sold or SG&A, these are some of these discretionary expenses that this spreadsheet asks you to separate from normal expenses. One is the owner's salary. Two is depreciation, and then of course interest. And I find it interesting here that we have debt, but we're not showing interest as an expense. That could be simply the way they account for their interest. I don't know, but in these financials, they did not show interest as an expense. They're showing rent. Rent will create a lot of questions. In other words, are they renting from a landlord? Do they have an LLC that owns a building that they're leasing from? And in this case, that's what they were doing. As we found out, they're paying $22,000 a month or a year rent here to themselves, and they brought that up to $41,000 and then $40,000. So they almost doubled the price of rent, but it's actually money they're paying to their own LLC, if that makes sense to you. And again, that's very common, but this could create some questions. With this client, this was pretty far below the market rate. and these numbers were more in line with the local market rate. And then we look at earnings before taxes and then any tax implications. And this was a company that was a pass-through, so there was no taxes. So if we look at this is a relatively typical small restaurant, I would say. Relatively rapidly growing sales. Like many restaurants, the owner is paying himself or herself very little in terms of net salary. That doesn't mean there aren't distributions. That doesn't mean, there aren't other, personal expenses throughout some of these other expenses. But in terms of a salary, that's what they're paying themselves. Okay. So now if we go down, one of the things this does based on cost of goods sold, accounts payable, is it allows us to calculate the operating cycle of the business. And if you look here, this is pretty typical for a restaurant. We don't have receivables because a restaurant, their sales are typically cash. They don't have any accruals, and accruals are payroll related expenses. But they do have inventory and they do have payables. So they're carrying in 2005, they carried an average of 104 days of inventory. And it took them an average of 110 days to pay their payables. All right. Here we're down to 31 and 31, and here we're down to 33 and 24. Okay. What are some examples we might think of, or some reasons that this might be happening? One is this could have been the first year they opened for business. And they could have had, a lot of inventory. They could have, been working with their vendors or on terms or something to extend their payments. So again, this isn't common. This, in my experiences, is more standard. You're looking at about a month. So, they're carrying their inventory 31 days and they're paying for it 31 days. Here, they're paying a little faster. So their operating cycle is 9 days. Now, what does operating cycle mean? Operating cycle is the number of days it takes to turn a dollar that goes into the business to return with a profit. So in this case, it takes about 9 days for us to realize that cash back from the money invested into the business, okay? So it's taking us about 9 days to generate cash from that dollar. Okay, now, in any business, we want that to be as low as possible. Healthcare, for example, is typically a long time simply because of the long collection and the low reimbursement process. But as you look at this, it's taking us about 9 days. Look at working capital, and we'll go into that a little bit more in a bit. And then we'll go down to the reconciliation of net worth, and you see all of this. And this number tells us, now this spreadsheet does it for us, but the reconciliation of net worth is where we find out, are the owners taking further distributions or cash in other ways. Okay, so we move the spreadsheet on over. Now remember, we got this information just from entering 3 years of income statements and balance sheets. Okay, so let's look at something in terms of cash flow. And this is where the rubber meets the road. We know the importance of cash flow. If you look up here at the top, there's something called gross funds flow. Okay, and this is the pure cash generated by the business. So it's profit after taxes plus depreciation and amortization, okay, or non-cash expenses. So this is the cash right here generated from our business. We had $18,475 in 2004, $51,000 in 2005. Okay, now the spreadsheet further goes down and kind of tells us the breakdown of where some of those expenses are sources and uses. You'll hear us talk about sources and uses. So if you look, our payables increased, which means it's taking us longer. We're keeping that cash, we're using that cash longer. And and then our cash flow, as you'll see down here, between uses and sources, went from $17,500 to $44,000. Okay, so of these gross funds flow, this is what we use some of that cash for. We also went down, and they did pay off some lump sum in their long-term debt. This may be why they're avoiding interest. I don't know. But if you'll recall, they're not paying their interest. They did show $5,760 in capital expenditures. So there could have been some equipment purchased as we go back here and look at their assets. there could have been some, with depreciation, there could have still been some capital expenditures here, and obviously there were. If the owners, through the reconciliation of net worth, if it didn't match up, then it would show that money in terms of distributions. Okay, so our net cash flow after all of our sources and uses, our operating sources and our non-operating sources, was $1,700 and $8,400. Now we go back and you'll remember the operating cycle. Our operating cycle was 9 days. So here we went from -6 days to 9 days, which means we had an increase in a permanent working capital need. So in the first year, in the third year, we need $6,047 in our system to maintain our working capital, or better explained, to carry the operating cycle of the practice. Okay, this is why you hear a lot of the business. This is why you hear a lot of businesses that run out of cash, is because they don't understand this operating cycle. If all of a sudden my inventory goes to 60 days, my payables go to 10 days, and my receivables, let's say, go up to 30 or 40 days, it's taking me longer to collect my cash, so my operating cycle is getting longer, which means I need more permanent working capital inside of my business to maintain the business, and that's this number right here. So I always have to have $6,000 cash. So the change in permanent working capital is $6,397 from this year to this year, which is a need or a negative number, plus my gross funds flow means I have $44,407 cash coming out of this business the way it sits. Okay. Now, if a typical banker, let's say we want to borrow $60,000, let's say we're going to borrow an amount of money that costs a payment of $2,000 a month. Okay. So that's $24,000 a year annual debt service. When a banker calculates debt coverage ratio, they will take that 44,407 divided by the 24,000, and that gives us a debt coverage ratio of 1.85 to 1. So for every dollar we need in debt service, we have $1.85 in cash. In my experience, and this will change, but banks typically look for about $1.20 to $1 in debt coverage ratio. So when you're working on financials, or when you're analyzing a business, this number right here is where we need to come from to determine if there's cash in the business. Now, if we're selling this business, let's think about this. Okay, this is quite a bit of cash, if we want to do this. But if I'm buying this business and I go back here, and you'll recall, this is a new owner going to be willing to work for $7,500 last year, or is he or she going to need $7,500 plus another $30,000, which would also decrease this to $14,000, and now all of a sudden their debt service doesn't work. Okay, so again, I'll include a blank spreadsheet for you to use. But I come across things like this, and I just wanted to put some quick information out there to help some of you out. This is a pretty simple spreadsheet. When you learn what to look for, again, I'm not a financial person. I don't look at all of these numbers, but I do know I want to shorten my operating cycle. I want my operating cash flow to be as high as possible. I want my owner's salary to be reasonable. I can't replace myself for this. So I'm going to need some more of this cash to come out of here. And you'll see, if I take my owner's salary, let's say I have to have $50,000. Now, that's going to decrease my permanent working capital down to $1,900. So all of a sudden now I can't afford this loan. Okay, hope this is helpful.